Many people trying to play politics in this market right now. Convince them they shouldn't.
How do you guess? We don't know how people are going to vote yet. We don't know. It's kind of 50-50. Right now, Biden's in the lead, but we know not to trust the polls from the last election. We don't know what the implication of the Supreme Court nominee is going to be. We don't know if they're going to have the Senate, if the Democrats are going to sweep and have both the White House and the Senate. I just don't think it's an investable event. But what you do have is hesitance towards buying. But I don't think it's possible. It would be just an unadulterated guess at this point to say, okay, I think X is going to win and this is going to happen. So this is what the market's going to do. You don't know what the market's going to do and whatever outcome may come until you know how the market trades into it. And history shows that when you have a significant equity market decline in the end of September into October, it usually means, according to the Ned Davis research chart that I use, it usually means that the incumbent loses. So I think the market's going to be a better tell over the course of the next month than any pundits.
Tony Dwyer, your charm is to say we need a recession for a down market. Do you see a recession?
No. Guys, remember what creates a recession. A recession comes when you have a need for money and limited or no access to the money. We have a historic amount of excess liquidity. We have the recession, the worst of the recession in the rear-view mirror because we shut down the economy. And we have a synchronized global recovery. Is it perfect and ramping? No. And I wish that everybody was employed in every small business. My kids have a small business. Every small business was doing great. But we are still having, even though it's not perfect, a synchronized global recovery according to all the data that any of us can have. So when you combine historic excess liquidity and a synchronized global recovery, the only time I've seen the data kind of like it is in the fall of 2009, which, as you guys know, I've been writing about, the concept of corrections like the fall of 2009. You had 4 corrections that ranged between 3% and 7% over the course of a month to a month and a half after the first 50% move off the low in 2009 and the recession was just beginning to abate and the recovery was in place.
Well, given that thesis, is this the time to double down on cyclicals, which, as John pointed out, underperformed yesterday in this new type of sell-off that we're seeing in response to no fiscal deal down in Washington?
Listen, it's a great question. Yes is the answer. I would double down. That's an individual question, so I can't answer that for anybody. Is it time to add risk when you're down almost 10% in the S&P 500 and more than that in the mega cap names? Don't forget, up until yesterday, the cyclicals were so significantly outperformed. It was the theme because they were so significantly outperforming the NASDAQ mega cap stay-at-home names. So clearly there was a bounce there towards the end of the day. You've taken apart the FANG stocks. They're back to where they were in May, right? So, the idea which we've propelled and kind of took a lot of incoming for a month ago to not chase them and to advocate taking some off the table and into cyclicals to some degree, that's been neutralized by the total drubbing in that space. These are good companies. They're not horrible companies. They've just gone up and to the right too much.